Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending April 28th, 2023. Looking at the market indexes for the week, the TSX and Russell 2000 were down. The S&P 500, Dow Jones, and Nasdaq were up for the week. Gold was up. Oil was down to $76 per barrel for the week. Stocks have stumbled a bit this past week, even as tech giants have done well with their earnings reports. Worries about First Republic's troubles have weighed on the minds of investors who are concerned about a revival of last month's banking crisis. Looking at Canada, on Friday, the Canadian month-over-month gross domestic product for February came in at a 0.1% increase, lower than the 0.2% increase expected. So we're slowing, but since the numbers are still positive, it's not a recession indicator yet. The Nanos Canadian Confidence Index came in this week, and consumer confidence rose to the highest level since June 2022. This is partly due to real estate, since it's expected to go up now that Bank of Canada has paused in its interest rate hikes, and Canadians' largest asset can now resume its price climb. The confidence is now sitting at a neutral level, better than before, but certainly not excited about the economy. It's the upward direction of the index that's important. Speaking of surveys, according to a survey that PC Financial conducted, almost one half of Canadians would prefer to clean their bathroom and toilet than create a budget. And almost 40% of Canadians surveyed avoid setting a budget or looking at finances altogether. Another survey that came out recently also said that many people are only $200 away from peril. So if they had come up with an extra $200 right now, that might put them into some economic turmoil. That should be looking at their budget right now and trying to figure out their finances. But they might be churning away and not wanting to face it. The recent PC Financial survey demonstrated that two-thirds of Canadians, 65%, believe that reviewing their finances once a year is enough, even if they're planning to make financial changes, which almost half, 44%, are as they file their tax returns, organize their income and expenses, update their budget, revisit their financial goals, or develop a debt repayment plan. Turning to the United States, the first estimate on US Q1 GDP came in this week. It was weak at 1.1% growth, with 2% expected. The markets didn't mind because it means the US Fed will not need to keep raising interest rates. But growth is definitely slowing, with an eventual possibility of a US recession. US weekly initial jobless claims came in at 230,000, less than the 245,000 expected. The US Personal Consumption Index came in on Friday, with the prices increasing 0.1% month over month for March, lower than the 0.3% expected, and the year over year for March was 4.2%, better than the previous 5.1%. The US Fed looks at this as an indicator of inflation, so there may be fewer interest rate hikes remaining. We are in mid-earnings season for the US Q1 earnings. 76% of S&P 500 companies that reported as of last Friday had beaten expectations, which is normal, but the expectations have come down for the companies to beat them. So far, companies are earning on average 6% less compared with a year ago, largely thanks to rising interest rates and inflation. Margins are holding up, and while we are in an earnings recession as the economy slows, we're still doing well overall. Now let's look at some big companies that reported in the US. Amazon had an excellent Q1 report, which beats on the top and bottom lines on Thursday, and its price shot up 10% in the after hours trading. Revenue topped expectations, and its AWS cloud business posted a 16% increase in sales. They have been cutting costs, especially on the retail business, where they overhired and overbuilt warehouses. Things turned murkier on the company's earnings call as executives offered a somewhat sour outlook on cloud revenue, noting that clients have continued to pare back their spending into the current quarter. Quote, as expected, customers continue to evaluate ways to optimize their cloud spending in response to these tough economic conditions in the first quarter, end quote, said Chief Financial Officer Brian Olsowski. Shares went negative after that. UPS had missed on revenues and profits in Q1 as the economy is shifting to services away from goods that UPS delivers, lowering their volumes. Coca-Cola beat on revenues and profits for Q1. Microsoft impressed investors Tuesday evening with its quarterly results, posting revenues and earnings that topped Wall Street's estimates. Shares jumped in extended trading. The tech giant also offered revenue guidance for the current quarter that exceeded analyst expectations, and executives touted the company's foray into artificial intelligence. Quote, we will continue to invest in our cloud infrastructure, particularly AI-related spend, as we scale to the growing demand driven by customer transformation. And we expect the resulting revenues to grow over time, end quote. CFO Amy Hood said. On Wednesday, a UK regulator blocked Microsoft's $69 billion acquisition of Activision Blizzard, however, but it's not of consequence to Microsoft, who can arguably earn more returns on cash than on the deal. Google's parent company Alphabet didn't wow investors as much with its earnings report, but it still delivered largely positive results. The company beat on top and bottom lines, and its cloud computing business turned a profit. Alphabet rang up better than anticipated revenue on YouTube ads, while overall ad revenue beat the street, but came in lower than it did in the prior year period, as an advertising pullback broadly weighs on the tech and media industries. During economic slowdowns, advertising is usually the first thing to go for many companies. Alphabet also announced that it had authorized a share buyback of $70 billion. Meta's earnings report blew away Wall Street on Wednesday, sending the Facebook parent stock surging more than 10% in extended trading. That means it's primed to build on its already huge 2023. Its shares were up more than 74% through Wednesday's close after losing 2/3 of their value last year. So, what impressed investors so much? Revenue rose unexpectedly and for the first time in 3 quarters, which is both good and bad. Its forecast for the current quarter also topped estimates, as did its average revenue per user. There was so much good stuff in the report that investors pretty much ignored the fact that the company's metaverse business lost another $3.99 billion during the quarter. The company cut 30% of its workforce, which will lower costs dramatically in the short run, but will hurt the company in the long run, assuming the people were being productive. Investors are happy that the company is refocusing back at traditional business and going less into the metaverse. Now, for a little bit of theory, the inverted yield curve, which is shorter term bonds yielding more than longer term bonds yield, which is counterintuitive and happens rarely, means that banks, which are borrowing on the short end of the yield curve when you deposit your money and are lending on the long end, technically have lower margins and will therefore lend less. Banks have not increased the savings account rates anywhere near the amount of the increase of the short-term bonds, so they are still profitable on their lending, but they will be lending less and only to the lower risk borrowers. This is bound to slow the economy. Finally, looking at next week, companies continue to report their Q1 earnings. On Monday, we have SoFi Technologies, Cargojet, which is a read on the Canadian consumer. On Tuesday, we have Starbucks, AMD, HSBC, BP, Ford, Dream Industrial REIT, Ballard of the hydrogen fuel cell. On Wednesday, we have Qualcomm, Airbus, CVS, Mercado Libre, Barrick Gold, Fortis, Brookfield Infrastructure, Tourmaline Oil, IGM Financial, Parkland Fuel, and Vermilion Energy. On Thursday is Apple, Canadian darling Shopify, CNQ, BCE, BMW, Volkswagen, TELUS, and Pembina Pipelines and Brookfield Renewable. And on Friday, we have Enbridge, Magna, Hydro One, Arc Resources, and Aritzia. Economic events next week. On Tuesday, we have the U.S. JOLTS job openings. On Wednesday is the big day with U.S. interest rate decision, which is generally expected to be a 0.25% rate hike. On Thursday, we have jobless claims in the U.S. On Friday, we have U.S. unemployment rate and payroll data, including earnings for wage inflation. And we have Canadian unemployment rate for April. That concludes my thoughts for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.